Welcome students. We have seen in the previous discussion all the models regarding dividend discount model. One is the N period model, the second one is the normal growth model, and the third one is supernormal growth model. And we have seen the limitations that if a company is not paying dividend, then we cannot use the dividend discount model. In fact, dividend discount model is the easiest model of all the free cash flow valuation models or time value approach method. You have two different approaches. One is a relative valuation approach, the other one is a discounted cash flow valuation. So discounted cash flow valuation, you have many: free cash flow to equity, free cash flow to the farm, dividend discount model. So dividend discount model is considered as the simplest one. But to use the dividend discount model, the company must pay dividend. But now we will discuss what if the company is not paying dividend or non-dividend paying stocks. Many companies do not pay dividend, thus the dividend discount model must be modified. We have to make little modification in the dividend discount model. How? Uh, if the company is not paying dividend means it is holding the money, right? The retention is more. The retention is more, 100% retention means the money is to be used to repurchase the stock. If that is the case, two consequences are arising. One, the more the cash the firm uses to repurchase the stock, the less cash it has available to pay the dividend. That's why it is not paying dividend. Number two, by repurchasing shares, the firm decreases its share count, which increases its earnings and dividends on a per share basis. So this time you are not paying dividend, you are using the money to buy back your own stock or repurchase your own stock. That means your own stock counting is going down. Because you are buying the stock, first implication, you don't have money to pay dividend. Second implication is, because you are buying back your own stock or repurchasing your own stock count is getting reduced. If your own stock is getting reduced, that means denominator is reduced in earning per share means net income divided by number of stock. Your number of stock is getting reduced. That means you are having more earning per share in future and more dividend per share in future. So in the dividend discount model, a share is valued from the perspective of a single shareholder, discounting the dividends the shareholder will receive. For example, a single shareholder, how will he look into? Price is equal to present value of future dividends per share. Now, values all of the firm's equity rather than a single share is equal to present value of future total dividends and repurchase divided by shares outstanding. Because now the money is distributed, right? The net income is now distributed into share repurchase and to dividend payment divided by outstanding. But in both the cases, the shareholder is getting the benefit, isn't it? So share is repurchased means future number of shares getting down. If future number of shares are reducing, the earning per share and dividend per share in future is increasing. The shareholder only getting the benefit. So the current price will be future dividends and future repurchases divided by shares outstanding. Let us take an example so that it will be more clear. Titan industry, as you know, very popular industry internationally, has 207 million shares outstanding, and it expects earning at the end of this year 860 million. Titan plans to pay out 50% of its earning in total, paying 30% as dividend and using 20% to repurchase the share. You see, the point is here. Before, what was the situation? We were seeing the company is planning to pay 50%, retain 50%, pay 60%, retain 40%, pay 80%, retain 20%, pay 100%, retain 20%, like that. But here, the company Titan decides to pay 50%, retain 50%. But the 50% paying will not be dividend. 30% will be dividend, 20% will be repurchase of your own share. If Titan's earnings are expected to grow by 7.5% per year, and these payout rates remain constant, then determine Titan's share price assuming cost of equity is 10%. Alright, the given data here is the earnings are 860 million, share outstanding 217 million. Now the company is planning to pay out of this 860 million expected earning, 50% will be retained, 50% will be paid back. But the paid back will not be in the shape of dividend. 30% will be dividend, 20% will be repurchase. And the earnings in future are expected to grow by 7.5% per year. And the cost of capital here is 10%. Let us make the share price estimation. Let us make the valuation of the share price. Based on the equity cost of capital of 10% and expected earning growth of 7.5%, we can compute the present value of Titan's future payouts as a constant growth perpetuity. The only input missing here is Titan's total payout this year, which we can calculate as 50% of its earning. Whether it is paid or repurchased, it is taken as paid out. So 50% is payout. The present value of all Titan's future payout is the value of total equity. Obtain the price of a share, we divide the total value by number of shares, that is 217 million. So Titan will pay how much? Out of 860 million earning, 50% will be paid out, 430 million. Using the constant growth perpetuity formula, we can make the valuation of this. How? 430 million divided by R minus growth. 430 million is the payout. So the expected payout in the shape of dividend and in the shape of retained in the shape of buyback is 430 million. So the valuation is equal to valuation of the cash flows is equal to $430 million divided by R minus growth. R is taken as 10%, growth is taken as 7.5%. So R minus growth is equal to 0.10 minus 0.075, 7.5, right? Am I right? 7.5% is equal to the valuation of the company, the valuation of cash flows. So this will be equal to 430 million divided by 0.025 is equal to 17,200 will be the valuation, right? So this way, if we are not having only dividend, we can make the valuation like this. Let us take another example here. 3M company has 698 million shares, same like we will do here. 3M company has 698 million shares outstanding and expects earning. I just minimized the full screen because I did the again full screen. 3M company has 698 million shares outstanding and expects earning at the end of this year 2.96 billion. 3M plans to pay out 50% of its earning in total. But how it is paying? Paying 25% as dividend, using 25% to repurchase the shares, but paying 50% to the shareholders directly, indirectly. If 3M's earnings are expected to grow by 9.2%, so the earning growth is 9.2% G, and payout remains constant, determine 3M's share price assuming cost of capital 12%. Very simple. You have to calculate whatever is the total earning, expected earning multiplied by 50% because 50% is total payout, 25% dividend, 25% repurchase. So remaining 50% is retention. So retention rate, whatever payout, that is 2.96 multiplied by 50% divided by R minus G. R is 12%. G is 9.2%. Let us do it. This is being explained here the same way. 12% is the cost, 9.2 is the growth. So it is a normal growth. Why normal growth? Because growth is less than cost. If that is the case, payment is necessary. So D1 divided by R minus G, or cash flow divided by R minus G, which we have done in the previous Titan case. So here the payout will be same like I know what you will do. Total the net income, the total earnings or net income, expected earnings multiplied by 50% will be the payout. Total payout is now 1.48 billion. 2.96 multiplied by 50% is equal to 1.48 divided by R minus G. R is 12%. G is 9.2% is equal to 52.86 billion. This present value will be the total value of 3M's equity. Now per share, how much it will be the per share value? 52.86 billion divided by 698 million shares outstanding, given in the company 698 million outstanding, 75.73 per share. So using the total payout method, we did not need to know the firm's split between dividend and share repurchase. To compare this method with the dividend discount model, note that 3M will pay dividend of 25%, that is 2.96 divided by 698 billion is equal to 1.40 is the dividend, isn't it? So 25% will be paid as dividend, 25% will be retained in the business. So 25% of 2.96 billion divided by 698 million shares outstanding is equal to 1.06 per share dividend. 1.06 per share divided by the price we calculated above, 75.73, is equal to dividend yield is 1.40. And the growth will be equal to expected rate minus dividend yield. Total yield minus dividend yield. Total yield given in the question is 12% minus the dividend yield we calculated 1.4%. So the growth in the company is 10.6%. This growth rate exceeds the 9.2% growth rate of earnings because 3M share count declined. Previously growth was how much? 9.2. See here, previously the growth was 9.2%. Because this repurchase, growth increased to 10.6%. That is because the number of share count reduced. Alright. So putting it all together, I hope the Titan and the 3M, in Titan also you can calculate the same thing. The valuation is valuation is equal to 17,200 billion, 1.7 billion or 17,200 million, and per share you can calculate is equal to 17,200 divided by number of shares outstanding. Number of shares outstanding is how much? 217 million shares outstanding. 217 shares million, 217. Do it, 17,200 divided by 217 is equal to 79 per share. The value will be 79.27 or $26. This way we make the valuation, and we made a cross check also with the growth. You see, we calculated the price for 3M 75.73. Then we have calculated the dividend growth. How? 25% dividend, 25% is buyback. So 25% dividend we have calculated, it comes 1.06 per share dividend. 1.06 divided by share price is equal to 1.4% is the dividend yield. You know, the growth is equal to the total yield is equal to dividend yield plus capital gain yield, and capital gain yield increased here. How? You see here, the yield came, or the growth came is 10.6%, but the previous growth was 9.2%. So growth increased by 1.4% here. Why? Because the number of share count reduced because of the buyback of shares. So putting all together, we as an investor, how to decide whether to buy or sell a stock. You should value the stock using the own expectations. You make the valuation. Either you can make the dividend discount model or other valuation techniques not discussed in this chapter. Here only dividend discount model is discussed. Other valuations like FCFE, free cash flow to equity, free cash flow to farm. Similarly, we can use the relative valuation approach like the chapter 2. We have seen the market value ratios. You make the valuations. Then, based on the valuation, compare with the stock price. If it is underpriced, buy. If it is overpriced, then sell. Based on that conclusions, you would buy or sell the stock. How could a stock suddenly be worth more or less after an earning announcement? As investors digest the news, they update their expectations, and buying or selling pressure would then drive the stock price up or down until the buys and sells came into the balance. Once it balances, stock price again will stabilize. What should the managers do to raise the stock price further? The only way to raise the stock price is to make value increasing decision or value added decision. So kindly make preparation of the chapter, and any question you can post me anytime. Just a minute, let me stop the recording.